guys. We're going to touch on order flow to start with, and the reason why we're going to touch on order flow is because we've spent so much time trying to get you guys to get the macros right. I can almost guarantee, I can almost sense that you're forgetting about the short-term order flow to make sure that your structure in terms of your trade entry is nailed on as close as possible. And in terms of trying to find some great trades, you're looking to try and put some information in your favor. And that information in your favor can be things like trapped buyers. How do we find trapped buyers or trapped traders? Let's change it to trapped traders so we don't have to type it out twice. How do we find trapped traders? Well, you can obviously use Sammy's little indicator called trapped buyers and sellers, surprisingly enough, or you can just simply look at market delta. You can just look at market delta. What does trapped traders tell us? Well, a very large delta candle, for example, should be pretty obvious. If I drew a little piece of chart at the bottom here, just for no reason, just into this area here, I'll just draw a quick candle, and I'll draw another quick candle. Which candle has trapped buyers or sellers on it? Well, the first candle has this number of deltas, and the second candle has this number of deltas. Well, obviously, anybody that's looking at this would say, well, if, and it's a big if, because there's a lot of deltas coming in here. The delta market delta guys call this a delta surge. If that delta surge is successful and we start popping hard to the upside, if there's some upside value, you're certainly not going to try and trade against it. However, if the price gets absorbed and we've got a reason to be short, then obviously that trap delta has to unwind and we're going to get the same selling coming in below the break here, yeah? Below the break. So in that type of situation, we can obviously watch market deltas, or you can just watch for the trapped buyers or sellers candle appearing and we can take advantage of that. What else would make sense? Well, if we get trapped buyers and we get a level 2 sell, do you think it's trapped buyers? If we get trapped buyers in terms of the deltas and it's a level 2 sell, as in the case like this one, think about what it is. Level 2 sell plus trapped buyers. Is it trapped buyers? What do you think? Is it trapped buyers? Surging deltas, a level 2 sell. The answer is we don't actually know. We don't actually know if it is trapped buyers, but what we can probably come up with is that it's almost definitely a stop run. Because what is a stop run? On the basis that this is a level 2 sell, there must have been a level. Agreed? So if there's a level, there's got to be stops above the level. If there's stops above the level, what are those stops? They're obviously buying deltas, aren't they? They're obviously buy-side deltas. So as we break through a top edge, there's going to be some buying deltas heading into the book. And that's going to give a delta surge at a top edge, which is instantly rejected. It's going to give you a buy, and if it was buying deltas, there would be a good chance, and if the market was still bullish, there would be a good chance the price would obviously wipe out and would just explode to the upside. But the fact is, if we get a level 2 sell plus the trapped buyer at the same time, as we did in this occasion, there's a very good chance that all that's happened is they've gamed some stops. You know why they've gamed stops, because the value line is now dropping, and therefore this combination is the perfect sell, isn't it? Really, this is what institutions do in terms of value, isn't it? Because if the value is dropping, and you can see the green line on this chart, this oil chart is dropping, if the value is dropping, we want to try and get people getting gamed at top edges. So we want to try and find those buying deltas at top edges, because a buying delta is a stop. We want to find those guys. We want to sell to them because they need to buy at that price, don't they? Because it's their stop, it's their exit. So we want to sell to these guys. So this combination of level 2 sellers and trapped buyers with the volume at the perfect top edge price of 51.50, with the open and the close below the volume, and then this rejection, you've got to look at that and say that is as close to perfection in terms of a simple order flow trade as you will ever see. You see that? It's almost the perfect order flow trade, because why the hell would anybody want to buy if the pressure line's declining and if the value line's declining? Well, nobody would want to buy, would they? But there's going to be some algorithms buying it to try and squeeze the guys that don't want to buy but need to buy if you get stopped out. Know what I mean? It's a stitch up, in other words. This whole trade is one big stitch up. And yet we've been able to highlight this trade as being a stitch up by seeing that HTB in level 2 sell at the same time. And if the value was obviously going up, it wouldn't be a stitch up, would it? Because then you'd say, well, what the hell are these guys absorbing that breakout for? They're just probably taking some profits. And what's going to happen is the price is going to recover to this, maybe this green buy side imbalance, and then just go bid back off the level again, isn't it? You see that? So this is a stitch up. This whole trade is a stitch up. We've managed to do exactly what you would have worried about happening. We've managed to do exactly that trade. And obviously what's happened is we've just annihilated everybody to the upside. Now here's an example of a stitch up at the bottom edge. Now unfortunately, unless you were following your Euro trade at this stage, you'll not be able to see the value of why the trade made sense. But let me show you a buy side stitch up. Does everybody see the buy side stitch up here? Look at the candle, look at the level, look at the level, look at the candle, look at the price level. 50-50. Do you see all of these things? A previous swing low, the 50-50. The price breaks to the downside, goes back to the top side, closes above the volume, and we get a level two buyer appearing and some heavy trapped sellers. Heavy trapped sellers. We're now targeting that sell imbalance above us. This is a stitch up. Now you might be saying, I don't understand because the euro's dropping at that stage. Well, you know, sometimes, as I said, sometimes the euro's stitching up everybody as well. Perhaps there's a buyer coming in on the downtick on the euro, but in this case, I can't point you to why the trade is making sense without looking at other pieces of information other than just the euro. But this is a perfect example of how to read order flow, rather than the perfect example of how to read order flow in relation to value that's developing. So it's not as good as this sell trade, but in terms of how the order flow is set up, it's pretty damn good, isn't it? It's pretty damn good. So what happens next, of course, is we get that break back to the upside. It's absolutely perfect. The price just went from 50.50 to a high print price of 50.85, and that gave you a great combination of trades. Now, when do we know this is a level 2 buyer? When the candle closes back inside value, of course. Then we obviously know that at some stage in here that we've got a level 2 buyer, and obviously on that basis, these sellers who are now weak-handed, once these guys get taken out, we'd expect to see a pop to the upside in terms of price. And that is exactly what happens once we get into this sell-side imbalance here. Once we get into the sell-side imbalance, look at what happens. Big gap between the volumes. Reason being, sellers throwing up the positions, and off the price goes up to 50.88 from 50.50. $300 of absolute beautifulness. You see it, guys? I mean, I can't make it up. It's on the chart. I mean, it is what it is. I can't make it up. So when we understand this, here's a level 2 buyer in here. Was there a reason for it? Well, perhaps there was this idea that we were going to be buying the euro again at the bottom tick price again at 2 o'clock, and that's what I was talking about to you guys earlier. So the euro's not the value line we're interested in, but take a look at the candle. Take a look at this level 2 buyer that came in here. Now, we don't get any trapped sellers like we did over here, but take a look at the candle, stopping volume. See the yellow line? Stopping volume. There's no selling coming in, but we've got stopping volume. We've then got an exhaustion print. We've got volume at the bottom and the open and the close above volume. Very good chance that that's going to be a reversal trade. 50, 60. It's got a level 2 buyer behind us, right there, level 2 buyer right there, 50, 60. Look at what happens 20 minutes later. It's trading 51.40. It's worth $800 in 20 minutes. It's pretty good, if you ask me, when you combine those elements, isn't it? Pretty damn good, if you ask me, when you combine those elements. And then when we started to sell off that 51.75 level, the open and the close below the volume, I don't get any cheeky level 2 buyers or sellers or any types of narratives up here that we can point to as having a special piece of information. But it is what it is. It is what it is. We can only show you what we can show you. And obviously in that type of situation, you can see that we've had a great little trade off to the downside. The value was divergent a little bit. We then come up, we got a reversal rob trade up here. We got a failed buyer's auction up here. The price then sold off of that failed buyer's auction for $200 in 15 minutes. So all we're doing, guys, is we're taking some screenshots and we're showing you the screenshot, we're showing you the theory, and we're trying to get you to understand the value of knowing where the order flow is giving you a trade opportunity. Because the problem for most retail traders is they might be able to spot value just because of the concept of divergence. Every single retail trader in the world knows what divergence looks like. So they should be able to understand value quite easily so long as they have the skills, and I'm talking about skills now, but so long as they have the skills to change a chart from a 5-minute chart to a fucking 1-hour chart or daily chart, then they've got the chance to make sure that they've got the right value understanding of the marketplace. And we've even developed the idea of value building beyond that in a little classroom we did this morning, and we'll develop into that again in this little classroom. So for the retail traders, I don't think the value is really that difficult. As I said, so long as you've got the ability to make sure you've got the right short-term and longer-term value on your charts. Where the difficulty lies is then pinpointing the opportunity. Now, we've told you what the institutions need to trade. Liquidity, which means you should always be looking for these level 2 sellers and buyers. And I think it was, if I'm not mistaken, it might have been Miguel says that the change in his trading came from, and forgive me if it wasn't Miguel, but the trading from his trading came from the recognition that the auction had failed on a break to the downside or to the upside. And you was able then to say, well, you know, I can use that information to now give myself an ability to enter into that particular trade entry. But you can see this in real time. That's the point. It's not a hindsight. Yeah, this candle develops. This volume moves up and down. The level 2 selling will develop into the trade eventually. The price might come back inside, go back outside, and the level 2 sell isn't a level 2 sell. So, you know, there's a lot of things that could happen during this trade formation. But at the end of the day, if you just take it as an end of candle scenario, and you'll be able to see these level 2 buyers or sellers on the screens, you'll be able to recognize them, you'll be able to then highlight them, you'll then be able to put a trade idea together based around what is happening with level 2 buyers and sellers. Then one of the things you can do is you can say, I recognize that candle. Now, if I can recognize that candle, can I use that information to try and take advantage of what's happening in terms of either the value read that I've got or the value read that I think is now going to be happening in terms of price bounces on the value line? Can I use that information to get the perfect trade and the perfect outcome? Can I target weak buyers or sellers? Well, obviously, trapped buyers at a top edge don't necessarily mean that there's a breakout buyer in there. It could just simply be a stop run. Now, obviously, if it doesn't have value, the trapped buyer might not be stop run. It might be a momentum algo trying to take the market bid, in which case you're just aware of perhaps some buying pressure coming in against you. But when there isn't any value in the trade, and you can see quite clearly that the trade should be getting sold, you can use these elements to find the perfect trade opportunity. Now, the one thing you'll always see me doing on the chart is finding those key levels. What did I do with the buy trade? What I did with the buy trade was I found the 50-50 level at the bottom, and found the buy trade. What did I do with the sell trade? What did I do with the sell trade? I found the 51.50 level at the top for the sell trade. What did I do with the sell trade on oil the last time? I found the 51.75 level to find the sell trade. What did I do with the natural gas trade? We found the big level at the top edge, the big handle at the top edge to get the short trade on. What did we do with the pound? We found the previous day high to get the short trade on. Previous day high to get the short trade on. So these levels don't suddenly just appear from nowhere. There isn't suddenly some randomness about when we enter and when we don't enter. You should always be aware that the entry will have a big surge in volume, and it's probably going to be at a key level. Well, if you know that, what the hell are you dealing in other locations for? Unless you're a scalper, a Momo type scalper, you're buying before she goes type trades. That's fair enough. You're not going to be at a key level because the key level was a fade trade. But what are you trying to fade other levels for? What would you try and fade 85 for, or 87? Why would you do that? Well, perhaps the value was getting so good that you got a level 2 seller at 87. You say, I'm going to take at least my first swing, but just accept that there's a high probability that if you sell at 87s, you're probably going to get squeezed out at the 100, aren't you? Because they're probably going to see that liquidity, and any failed auction is going to be a buy, squeeze, so that you can buy into that trade, squeeze the shorts, and then try and get the price up through the handle. It's not as difficult as you might think, is it? There should be a matrix attached to every single trade you take. The matrix is based around the volume, and the volume is based around the time and the levels. Volume is always based around time and levels. When's the highest volume of the S&P? 2:30 and 9 o'clock. Why is that the case? Because the open and the close. Where's the biggest volume on the NG? Well, some key levels. US cash open, US cash closed. Where else? Weather news. We get a spike in volume when the weather's significantly changed. Where are we looking at for the pound? 8 o'clock in the morning. Absolutely. Where are we looking at the S&P in the morning session? 8 o'clock in the morning. 8 o'clock in the morning, we're looking at the S&P. Are we going to be doing a deal at 8 o'clock in the morning? You might be saying there's no volume at 8 o'clock in the morning on the S&P. There isn't, but there's volume at 8 o'clock in the morning on the FTSE and the DAX, and they're the markets that's going to drive. And look at what happens. 8 o'clock in the morning, price is trading up into 8 o'clock in the morning. Top edge, boom, over $1,000. It's not that difficult, really, is it? It's really simple when you put it into a little summary like this. It's really simple. It doesn't mean you're going to get the first trade right at this level or the second trade right at this level, but you've got to work that level now. You've got to try and understand that there is a trade, and obviously this trade here is based upon something that we're going to be talking about in classroom once we finish this little section, and that is the shape of the curve. So this was a perfect short for me. It was the perfect location. It was the perfect liquidity. It was the perfect level. It was a perfect time of the day. And we ended up with an enormous profit to the downside. Enormous profit to the downside. Killed it. Absolutely destroyed it. Absolutely destroyed it, guys. So what else are we looking for then when we're looking at these things? So we've just established that in the right location, at the right time of the day, in the right key levels like 51.50 here, we want to start looking for trap buyers. We want to start looking at market delta if you're not using a trap buyer indicator. Some sort of market delta that's surging into the market being absorbed. We're looking for absorptions. We're looking for exhaustions. And then we're looking at this idea of saying, well, we've got something to target. So like buy-side imbalances. Now, some of you might say, would it not be better to get a sell-side imbalance? For a retail trader, as a momentum trade, yes. As a momentum trade, yes. If you get a sell-side imbalance, it means that there's been effectively a withdrawal of liquidity on one side of the book, and therefore you should be able to make money by buying away from the buy side imbalance and selling away from the sell side imbalance. But that imbalance is a scalp trade. It's got to be. So if I'm going to target a buy side imbalance, the reason why I'm targeting a buy side imbalance is because obviously that's another way to identify that there's possibly still some trapped buyers at a certain price. So when I see that buyer being trapped, then fair enough. But you can trade in terms of scalp trades, guys, once you see these imbalances developing. You can see, for example, if I just looked at buy side and sell side imbalances on oil, you can see that if I took a pop at this sell side imbalance here, you can see it traded lower. If I take a pop at this buy side imbalance, I probably wouldn't take a pop at the buy side imbalance here. The reason being the volume is above me and I'd be trading up into the volume, and that's a bad trade for me. If I traded away from this sell side imbalance, there was a sell side imbalance came in here. Yeah, possible. This buy side imbalance here, as it was going up, the volume was below me. This would have been a nice momentum buy trade, carried on nicely. And you can see obviously that this little buy trade here, which happened in real time, I can't tell you where the volume was because I didn't see it in real time, so I don't know where it was. So you can use these to scalp information from. If you've got a buy side imbalance on your order book, that means there is obviously some sort of withdrawal of liquidity by the market makers. Otherwise, why is there a buy side imbalance? But we want to target buy side imbalances. This is an easier trade for the institutions because a buy side imbalance means what? A buy side imbalance means sellers below the level. Yeah. A buy side imbalance means there's got to be a seller below the level. So when I've got a buy side imbalance here on this little chart, you see the little red square. If I've got a buy side imbalance from this level, that means there's going to be sellers throwing up their positions if we can get through that level. So when I sell up here, trying to capture this, I've got to be aware, number one, that there was a buy side imbalance, and we watch. And then when we start seeing these exhaustion prints into the buy side imbalance, the buyers aren't defending, they're going to throw up and we're going to get a nice break to the downside. So I want to target a buy side imbalance on these types of trades. That would be perfect for me, wouldn't it? If I could target a buy side imbalance, it should always be the perfect trade. Well, think about that level 2 buy that we were talking about earlier. Do you see what we've got just above us? Look, this level 2 buy trade. So we get the level 2 buy trade, we get the stopping volume, we get the exhaustion print, we've got the volume, but look at what we've got above us. Sell side imbalances. See the red line? Sell side imbalances. So we can target those sell side imbalances, can't we? Which means if we can clear those sell side imbalances, we should see an asymmetrical pop to the upside. Well, trying to get into an asymmetrical pop must be a valid opportunity for people to deal. There must be a reason that this market explodes really hard when we get through these key levels. And that reason is that these guys are throwing up their positions. The market makers got to try and screw them for all they've got. And we end up getting a big asymmetrical response to that trade. Probably too big a response to that trade, but nonetheless a big asymmetrical response and a very, very nice outcome. So in summary, you shouldn't be dismissing your order flow. In fact, quite the opposite. You should be constantly trying to train your order flow, looking for rejections, looking for trapped sellers, looking for the right elements, trying to find the idea of who am I targeting and why am I targeting and what's the value line doing to allow me to take advantage of what happens next. If the value line's in my favor, when I'm getting a level 2 buying at the bottom edge, then that's fantastic. It's just a long accumulation. If the level is against me, it might just be a short covering rally and we might be looking to try and get back into a short trade following the scalp buy. Is the sell side imbalance drawn by OF software? Yes, it is. What did David call it? I don't even know what we called it. Buy side imbalance or something. I don't know what we called it. But it's in the OF package, absolutely. And all I've done is I've changed it from 3 to 2 in terms of in terms of the multiple so that we get more examples of prices that we stacked imbalance, Tim, thank you. We get more examples of stacked imbalances. So I've changed the setting from 3 multiple to 2 multiple. And the reason for that is just simply, as I said, we can look at trying to target these types of things in the process. We can look at trying to target these kind of things, okay? So if there's no questions about order flow, we'll take a little break, guys. We'll take a little 2 minutes, and when we come back, we'll talk some curve. 2 minutes, and everybody goes, "Oh bloody hell, not the curve! It's time for me to go and get dinner. Stick dinner on, eh?"